Thank you for sitting down with us today. We are holding this conversation at a fascinating macro juncture, for DeFi here in mid 2026. Across the wider industry, we're watching a quiet identity crisis unfold. Compressed on-chain yields are fighting for relevance against traditional risk-free rates. Borrower utilization is hitting unexpected bottlenecks, and the old consensus around general purpose layer 2 scaling is rapidly fracturing into an era of vertical integration and protocol M&A. Now, Katana has positioned itself right at the epicenter of these industrial shifts, between guiding the network through a recent token generation event in an imperfect market, executing the acquisition of the veteran IDX team, to build out, your own derivatives layer and your own transition from institutional business development to the CEO seat. You have had a front row view of this structural alignment. Today, Matthew, I want to use your vantage point to look past the standard ecosystem metrics and talk more about the hard macro realities of where the digital asset market structure is heading. Let's start with that overarching yield environment.
Yeah, thanks so much for having me. I'm really excited to be here and happy to get into a lot of those topics.
Across the board, Matthew, in when in mid 2026, we're witnessing a historic, kind of a macro shift. The DeFi yields, compressed significantly due to lower leverage demand and repeated protocol exploits. Now, frequently sitting well below the traditional risk-free benchmarks, like the US Treasuries, right? Now, if macro capital can get a higher, safer yield from a real-world T-bill, then a smart contract vault, how do you think does the wider lending ecosystem survive? And what is the industry-wide playbook then, to keep liquidity from permanently fleeing back into TradFi?
So, I mean, structurally, some of the on-chain use cases are in the composability that DeFi has created, sets up what there is like a baseline of demand for lending yields, even if that means that you would earn more off-chain. People love like the flexibility, especially on the weekends, to be able to take advantage of different arbitrage opportunities. Variety of different kind of crypto market makers or trading kind of firms like want to do that first and foremost. In terms of like whether producing rates that are lower than the treasury bills is going to result in capital fleeing off chain. I think that will happen, and like there's been a lot of demand and interest from fintechs and ever institutional allocators and private credit funds like Apollo or traditional ETF providers like Bitwise are all kind of coming on chain in this more focused in a business. And if the rates are sustainably like lower or they're not sustainably higher, rather, you will definitely not see as much capital flow on chain unless that also comes with borrowing demand on chain as well.
I'd say there is a quiet, crisis in DeFi right now, regarding a structural borrower shortage. Protocols are awash in stablecoin supply, but then there aren't enough institutional retail borrowers to sustain organic double-digit utilization rates. Why has borrow demand decoupled so sharply, from the broader crypto market rally? And what infrastructure primitive do you think is missing to fix this utilization bottleneck?
I would say there are a few different reasons. One is like on the product side. So I think Coinbase Earn was one example
Mm,
of bringing borrowers on chain without them really fully understanding that they're kind of like borrowing on chain. And the reason that I think that this is a good example of a product is because those borrowers are very like rate insensitive. Like the rates that they're paying on borrowing on base Bitcoin against stablecoins is like significantly higher than you can get on a lot of other chains.
mm,
Which I think shows that like, hey, like they're fine to borrow with at an extra even like 2% higher
mm,
rate. If that means that they can stay within their Coinbase app, and if that means that it can still feel and look like a centralized kind of exchange experience. So I think the borrowing, like the products kind of bringing on chain, like have to kind of mirror the supply products that are kind of being brought on chain because it really does feel seamless, depending on how Morpho and some of these other lending infrastructure integrated, like where you really just kind of one click deposit and you're like earning funds. It's the same as you deposit onto Robinhood or deposit into other examples like that. Whereas obviously borrowing itself is a lot more complicated and you have funds at risk in terms of liquidations and all that. So I think the product is one example of it. I think having assets that, yeah, people want to borrow against obviously is another thing, and demand from leverage. over, I guess, like this past like year has just been lower than yeah. And so like that's the primary reason for people to kind of borrow on chain is to get access to leverage against assets they want to hold either longer term or assets that they want to double down and loop.
Your recent acquisition of the veteran IDX team, to launch the Katana Perps, is seen to be an aggressive new industry trend, towards consolidation. For years, the prevailing crypto thesis was that independent multi-chain dApps would rule the space. Now, with chains now buying out protocol teams to own their own spot, the spot lending and the derivatives vertical in-house, do you think is the era of the isolated standalone dApp is effectively over, or are we moving into an era of a monolithic kind of a DeFi super apps?
I think that's something that we thought a lot or a good amount about in general. I think about 2 years ago, or when I was looking for like my next role personally, I
Mm,
was kind of sick of new chains and saw a bunch of chains raising that kind of crazy valuations, and also thought like, why do we need new chains? I was a builder at one point that we did uh, a multi-chain AMM that was built for yield-bearing tokens. We worked on like a liquidation-free lending protocol on multiple chains too.
mhm,
Um, and there's obviously this whole like L2 thesis back then, and there was a lot of grant farming across like the ecosystem, which also then created an amplified mercenary capital, kind of going from one opportunity to the next.
mm,
And I think um, there's been like other examples as well where like you don't really need to be multi-chain in some of these use cases like Polymarket and Hyperliquid. Like it's not something that's on a bunch of chains either. And I
mm,
could talk a lot about this, but I think in general, like general purpose blockchains are waking up to the fact that they really need to drive real revenue streams and kind of provide like an experience that is really like specialized in some way and focused and the best at like one or two or three things rather than having like this full-fledged ecosystem around that. And so there's a lot of names that we could kind of mention here, but I think in general, Polygon kind of had this thesis and they're just focused on payments, and Katana has this thesis, they're just focused on DeFi. And so what we believe is like in these verticalized chains, within that, you can make verticalized chains look like a super app. So on Polygon side, they're building the kind of this open money stack that's all about payments. And on Katana side, we kind of have this super app in a way where we have a vertically integrated exchange where we own the perp side, soon to be owning other applications as well. And we have Morpho like all kind of embedded into our own app. And so our view is that competition should not be at the infrastructure layer. It should actually be the layer on top of it. And so ideally, the chains are making revenue and margins at the infrastructure layer on spot, on perps, and these kind of things. And then you have a bunch of competitive landscape of builders that build on top of it that deliver unique user experiences, and they earn money on that way too. So
So, Matthew, the ongoing debate over Ethereum L2 fragmentation and network alignment has reached, I'd say, a fever pitch, with critics arguing that general purpose L2s break at scale because they fracture liquidity across dozens of isolated bridges. Someone who's built within Polygon's ecosystem and now runs a hyper specialized DeFi chain, do you agree that general purpose scaling has fundamentally failed the end user and is strict vertical integration now the only way to build durable liquidity?
yeah, for sure. I think like general purpose belt twos and all that made a like kind of bet that like block space is the product, and it's not really. It's more like the economic activity. And so in a way, like when these general purpose blockchains like optimize for nothing, they or optimize for everything, you kind of optimize for nothing. And so at Katana, we really focused on creating like a sustainable revenue model where as you said, like the liquidity incentives are kind of concentrated at the infrastructure layer at the base, and then we kind of build other products like on top of it to deliver like other user experiences. And so I think that that's what we kind of believe in, that there's been more and more chains which eventually kind of got commoditized at the infrastructure layer. And so yeah, delivering something unique and more hyper specialized is what we've kind of been focused on.
The market today, it seems, is experiencing severe points program fatigue and aggressive post TG token dumps, proving that using inflationary token emissions to artificially inflate TVL is a dying growth model. Now, having recently launched the CAT token into what you've accurately described as an imperfect market, what is the industry's structural alternative then to emissions when it comes to bootstrapping a network without really triggering a token price death spiral?
I would say in terms of bootstrapping a protocol, I think incentives, points, and tokens is something that has been actually powerful and getting people to come and try out new products. I don't it's not sustainable, as you mentioned. What
Mm.
what Katana sought to do from the beginning is to have a different economic model where it's not only funded by token emissions, and it'll be funded by less token emissions kind of over time. So the USDC, ETH, Bitcoin, USDT that's bridged from Ethereum mainnet to Katana, it's actually lent out on Morpho, Ethereum L1, and these prime vaults curated by like Steakhouse and Gauntlet. And the yield that's generated from to Katana, like the chain. So we earned about $600,000 revenue in March, about 4 million since launch, and that can provide an extra layer of yield to users. And importantly, it's not yield in the form of cat tokens. It's actually yield in the form of more USDC, more ETH, and that does like actually move the at scale. So in a world where Katana had billions and billions of TVL, we're obviously not there yet. That is a very like powerful source of revenue that can be weaponized and delivered in a very opinionated way. And because we built the ecosystem in a very, I guess, opinionated way that's now turning into this ownership layer. Having like the synergies with just like one kind of core protocol or primitive can actually make that yield sustainable and meaningful at scale.
Many founders are launching tokens this year, and they're complaining bitterly about the CEX gatekeeping problem. Where centralized exchanges demand predatory listing fees and massive percentages of token supply. Kind of effectively sucking the economic value out of a decentralized community. How do you think then? Is this gatekeeping altered? How protocols must approach market entry, and do you think can decentralized launchpads natively scale to bypass these centralized choke points?
Yeah, so the fact of the matter is that if you look at the stats and the user bases of centralized exchanges and different chains, like it is worlds in a way, a different story. There are tens of millions of users on Binance, on Coinbase, on OKX, on Upbit, and that's what they know and that's what they use. And it's a lot easier for them to kind of use that. And so in terms of distribution and getting the name of your token out there and the ticker and the volumes that kind of come with it. Centralized exchanges play a very important role today in that sector. I think there are a few projects that have been able to launch on chain natively and have hit kind of escape velocity. Obviously, one is like Hyperliquid, that's pretty famous for that. But the reality is, a lot of projects are not in that same kind of ballpark. And so, in general, if your product can get to product market fit, these centralized exchanges will want to list you, whether you want to kind of pay them the fee that you're alluding to, or not. And so, I think that has just been like one thing, but I would say that yeah, they do at the moment play a very important role in terms of distribution. That's what they have. It's kind of like that's just one part of the industry and the market participants that you can either choose to play with. But I think it's nice at the same time that because of the way some of these other ecosystems and chains have developed, like you can come launch your chain on chain, and that can be a strategy that might be better for you. But I think product market fit is probably the most important aside of anything else. So
And following repeated cross-chain exploits in this industry is rapidly kind of moving away from monolithic one-size-fits-all liquidity pools towards a more curated risk model, like Morpho, where users choose specific risk managers and vault curators. Does this shift suggest that DeFi has structurally admitted it cannot rely safely on automated risk management at the protocol level, and the future of on-chain finance must rely on human gatekeepers after all?
yeah, I'd say it's a very interesting question. I think what we're witnessing right now is the institutionalization of DeFi, and I think that has some pros and some benefits in terms of bringing more liquidity and onboarding serious capital into the space who has been managing and underwriting different collateral mixes for a long time, whether that's on chain or soon to be like more and more managers coming from the off chain world to come on chain too. Yeah, I would say that the curation aspect is definitely a strong trend. There are still options for people that have more of the crypto or cypherpunk kind of ethos and have everything automated and managed for them. And there's a whole spectrum of from people that we say like multi-sig fi
Mm.
versus people more like Yearn who have tried to build a lot of these automation and optimization and like rebalancing kind of within the protocol itself.
We're seeing a major push, from major fintech platforms like Revolut, and even centralized programs like OKEx earn to route retail capital into on-chain backends for yield. Now, as a veteran of institutional business development, do you worry that this institutionalization will ultimately sanitize DeFi, turning public blockchains into invisible, highly regulated back-end plumbing for legacy, for legacy finance rather than open permissionless networks?
I think the regulatory tailwinds in the US around public blockchains have shown like there is a path for public blockchains. I think the
Mhm.
risk and the concern that people had in the future that or the potential future that you outlined was a lot more real, a
Mm,
few years ago, but I think with this current administration, there's been, like, a strong willingness to build on public blockchains and optimize for privacy and sanctions checks and, KYC, and all of that kind of permission environment within, like, a public network.
mm,
And so, like, the next kind of hurdle to get through is try to aggregate the liquidity in the use cases rather than kind of fragment them between permissioned liquidity and permissionless liquidity. And
mm.
that I think that's like the next step.
Decentralized perpetual futures volume crossed, approximately 6.5 trillion, more than 6.5 trillion actually, globally last year. Yet almost every major protocol is forced to strictly geo-block US participants to avoid regulatory crosshairs. Now, with the US showing early signs of a regulatory thaw, but remaining highly litigious, is the global derivatives market permanently fractured into a US versus the rest of the world dynamic, or do you think is there an on-chain architectural design that can compliantly bridge the two?
So the design would be KYC front ends, but having a decentralized protocol running in the back end. And so you could potentially imagine Hyperliquid having a KYC front end in the US and having other people run different front ends outside of the US and
Mm,
having like kind of the same underlying liquidity that is like being quoted. I think it'll be interested to see. I know that the centralized exchanges are making some progress in Washington D.C. as well on how like historically the liquidity has been fragmented between Binance US and Binance Global, OKX US and OKX Global, Coinbase US and Coinbase International. We'll be interested to see how like those liquidity streams are commingled at the centralized exchange level. I think before anything happened on the decentralized side, like that probably is like the first kind of blocker, considering that they have KYC users and all of that. So I think, yeah, it's unfortunate that US users have been gated and geo-blocked so far, but I think the CFTC has shown willingness that they're really trying to figure out and how to make something work. And I think
mm.
the SEC just had an announcement earlier this week on leaning into tokenized digital securities as well. So we'll see what happens.
There's a growing industry reckoning regarding no vanity metrics. A blockchain can show hundreds of millions of dollars in TVL or a dashboard, yet suffer from massive slippage, high rate volatility, and complete hollow organic trading volume. How should the market then, according to you, Matthew, re-engineer how it measures success and the economic health in DeFi if TVL is proven to be an easily manipulated and unreliable indicator?
It's definitely tougher in crypto, and it's been like a learning process since, I guess, DeFi summer in 2020. There's a lot of different Sybil farms and ways to manipulate the data. Uh, I think at Katana, for example, we just ran our first trading competition 2 weeks ago, and we did spend a lot of time going through and making sure that the rewards were going to real users and not like bots or people that were just trying to farm the points. And so there's different systems and things you can build into place to try to determine which users are real and which ones are bots. And so I think that that is like part of it. In trying to like it's on the projects to try to figure out what the great data is and the research providers as well to then publish like correct data. And you've seen DeFi Llama as like one like great example of a team that really tries to uncover these different things. And you see people like Zach XBT and stuff like that more on like the exchange side or tokens and preventing and pointing out manipulation on that side too. So I think yeah, it's kind of in terms of TVL like there's a lot of backroom deals and there's a lot of like on-chain incentives, and so I think part of it is trusting the team that you're going with, and then also I think survivorship bias is a huge thing too. You look at some of the teams that have been around for multiple cycles now. It's pretty hard to be around multiple cycles if you're blowing all of your token incentives to manufacture TVL in the short term.
Matthew, thank you for being so candid. It's clear that as the industry moves past the era of easy emissions and vanity metrics, the survival of DeFi will come down to hard architectural choices and real economic utility. We appreciate you giving us a look at the blueprint from Katana's vantage point. Thank you so much for your time.
Thank you so much for having me.